Agam Gupta, MD of FI Trading at Standard Chartered Bank, also joins in on the show. And Agam, the global comments have definitely come as a shot in the arm. The question really remains, if we look at the domestic cues today, the bond yields continue to trade above 9%. The currencies had a bit of a favorable turn too. What have you made of all that's happening around?
Yeah, I mean, as you pointed out, the rupee has appreciated in the last three trading sessions. It's primarily due to the fact that there was kind of clarifications from the RBI governor saying that a lot of the oil demand is already in the market, and that was the cause of the slight amount of weakness that we saw. Subsequently, there has been dollar weakness overseas, and also we are seeing some significant inflows into the country today, probably in the form of FDI. That's what we can tell you anecdotally from the market. So all in all, I think the demand-supply mismatch is not really massive, and we continue to trade in balance at around 62, 60 right now.
Agam, do you think the RBI's bid to have this OMO bond purchase is really a response to the fact that the last auction, they did not accept all the bids? So clearly the RBI was not happy with the rates being quoted. So is a bid to groom the market, as it were, and get government interest rates pushed down artificially?
Well, I mean, OMO is basically a tool to inject some liquidity, and the RBI has clearly kind of shown a bias towards the short end of the bond curve. So they're clearly trying to inject some liquidity by doing the OMO. They are kind of concentrating on the very short end of the curve, which is a change from what used to be earlier. So I don't think they're trying to push down the government bond yields artificially. They're just sticking to their mandate of providing appropriate liquidity to the system, and that's what they're doing right now.
So you would not agree that this bid to increase the liquidity is driven not so much by the desire for banks, is a liquidity crunch that the banks are facing at the short end, but it's driven by that rather than the fact that as the RBI, as the debt manager for the bank, the merchant for the government, the merchant banker for the government, has a key role also to keep government interest rates low. So which of these two factors, the liquidity crunch of particularly some of the private sector banks vis-a-vis the government's desire for low rates of interest, which one do you think has come uppermost in the bid to have the OMO?
It's definitely the desire to inject appropriate liquidity to the system, and I mean, it probably had a knock-on effect on the bond yields. But if you look at the maturity of the bonds that they've announced in the OMO, it's predominantly on the short end, which clearly shows that their preference is to inject liquidity and let the market determine the longer end rates.
Is there some contradiction between the RBI's focus on inflation at one level, at the same time trying to infuse liquidity at the other end?
Not really. I mean, they have taken measures to check inflation. They have hiked rates twice in the last two meetings, and they've made an analysis of the inflation trajectory. In fact, his statements of late have shown that they are comfortable with the trajectory right now. And they are cognizant of the fact that inflation remains high, but I mean, in their analysis, they have done quite a bit in controlling the inflation, and they're going to wait and watch how it pans out. So I don't think it's contrary to the mandate or to their objective of controlling inflation. I mean, they have to provide appropriate liquidity to the system. They are not flooding the system with rupees, but they're just providing appropriate liquidity.
And what is your sense of roughly what proportion of OMO's demand is? OMC demand, is back in the market? Mr. Mayaram mentioned 40%. The governor did not mention any number. Do you think the bulk of it has come back, or it's only still less than half that has come back?
Well, the governor mentioned that the majority of the oil demand is back in the market. So I'm just going by that statement, and so I would assume more than 50% is back in the market. How much more than 50%? That's a difficult one to say.
And what do you think would be the impact? When do you expect these swaps to be rolled over? And if it happens at the time when the Fed starts tapering, what do you think the consequences would be? Will the RBI be forced to roll over the swaps? Or will it have the courage by that time? Hopefully it's built its reserves. And will it say, okay, let's not roll over the swaps? What is your gut feel?
They're gonna see how the market condition is at that time, and they're very, very clear. They have a clear strategy in mind. If the market conditions are favorable, if there are supplies which are dollar supplies have returned to the market in a significant way, they will let the oil companies buy those dollars back in the market. Otherwise, he's clearly spelled out the three options in front of them. So my view is that they're clearly cognizant of the fact that once these swaps mature in Feb, March and April 2014, there will be something need to be done. Either the oil companies have to buy the dollars, or the rollovers happen, or they settle in rupees. So as long as they're clearly cognizant of the risks, I'm confident that they'll kind of manage the situation depending on what the conditions are at that moment.
Maithili, just wanted to dwell on the point that you brought up earlier, speaking about the RBI being serious about controlling inflation. Now, the RBI governor has clearly maintained that no single data point is going to determine his next move. But what is it that one should expect, given the sticky inflation? Is it going to be a hike of 25 basis points followed by a prolonged pause, or continued rate hikes coming about?
Well, it's a little difficult to say over the medium term, but certainly in the next policy review, I do anticipate a 25 basis point hike. Subsequently, it will depend upon how things pan out, what the inflation data reveal, because as the government approaches inflation, they will be much more serious about, allowing the RBI to do whatever is required to get inflation under control. So my sense is that the next review we will see a 25 basis hike. After that, we'll have to see what the inflation numbers are. If they continue to be high, then the RBI will get a free hand from the government that say, look, do whatever you want, growth goes in the back burner. Right now, we have to get inflation under control because that's the only way we're going to get re-elected. So I think it depends. Yes, immediately, yes, 25 basis hike, but after that, we'll have to wait and watch.
Agam, is that the sense that you get as well, that yes, the current inflationary pressures seem to be strong, so maybe a 25 bips hike that could happen, but that would probably be the end of it, because even the even the micros might become favorable because of falling food and vegetable prices, and therefore the inflation numbers could also be contained?
Yeah, actually that's our view too at Standard Chartered. We expect a 25 basis point hike in December. We expect a pause after that, and maybe that would be enough. We expect that even the CPI will trend down from the current rates towards 9% by March end. We expect the WPI to also trade between a 6.5 to 7 kind of a range. Expect the kind of the weak growth momentum of the economy to kind of have a benign impact on the inflation prints going forward. So yes, we expect a 25 point hike, and then we expect them to stop.
Agam, what is your explanation for the fact that Moody's has given a pretty drastic negative report on the outlook for Indian banks, and yet we've seen the Bank Nifty look up? Is there a contradiction, or is it just part of the fact that nothing really makes sense anymore?
Well, I'm not an expert on the equity markets, but I would just assume that there are some inflows coming in from the FIs, and that was causing the up move in the bank index today.
Agam, before we let you go, just a word on where you see the currency headed, because we certainly have seen some recovery kicking in. Is this here to stay?
I think we are in a range. We had gone down to 61, and that's when the oil demand returned to the market, or whatever a majority part of the oil demand came to the market. That caused a move up to 64. I think that 64 was strongly defended on its own, and I think we're going to stay in a range of 62 to 64. I don't really see it trading below 62 in the coming few weeks, but I don't see it going above 64 either. So I think we're in a range of 62 to 64 for the next month or so.
Great. Agam Gupta, Maithili Busnumar, many thanks for joining in today and giving us your perspective.